Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Like in a game of football, the pitch is your financial center stage. Like scoring goals is your topmost priority, there might be some obstacles in the runway, right? So, how can you assure in achieving your financial goals there are no certain obstacles? Come join an upcoming webinar to clarify and get to know more about how to reach the runway and score your goals very efficiently.
Why are we cautious on small caps? Small cap is a space which we have enjoyed so much. We have participated in multiple companies, in multiple teams over the decades, and seen these companies literally rise from a few crore valuation to a few thousand crores today. Some small caps have become multi-billion-dollar companies also. So, that fascinating journey which you see in a small cap, which you experience, and which you learn from, can never be experienced anywhere else in the market. Also, when you look at a company as a small cap, it has a lot of uncertainty. It's less predictable, but it has a long runway of growth. It is this long runway of growth that excites all of us, because even if we are wrong on the timing or on the entry valuation, by giving more time to our investment, chances are that we would make good our error in timing. But that was in an era where small cap multiples varied between low single digit, which could be 2 or 3, to 24, 25. But now it looks like the bottom of small cap valuation is closer towards 18, 20, and the top is quite extended and very, very stretched. So the top could be even 150 times or 100 times or 80 times. It could be anything. Now, this is not a familiar scenario for any of us who have invested in small caps for decades. It gives us a sense of uneasiness. We are definitely not comfortable seeing those extended valuations. Look at the lower end of the valuation band, and we are suddenly wondering that what used to be the higher end of the valuation band in small caps today is the lower end of the valuation band. That's another very, very disquieting thing, which is why we have been cautious on small caps, and we are very, very company specific and very, very valuation driven in approaching investment opportunities in small caps. But that's not the case with how the institutions and the retail investors who are in mutual funds are viewing small caps. For them, it's become the growth space. And that's where the money is coming in, and no one wants to turn away the money. So they are collecting huge sums of money in small caps. And the very velocity with which money is coming into small caps is further fueling a rally in them, at least in the institutionally overowned companies. So if a company is very heavily owned by mutual funds and those fund schemes are getting more money, they have no option but to buy more shares in those companies as they receive funds. Now, we are of the view that investment decisions cannot and should never be liquidity driven, whereas these decisions are entirely liquidity driven. That's another red flag for us on the small cap space. These are the factors that make us cautious on small caps. We'd rather be cautious today and conservative than being aggressive now and sorry later. Because when you are in a state where you feel sorry about what you did, your comeback is going to take much longer than you can bear. And that pain of waiting for a comeback can demoralize and demotivate any investor. That's really the crux of this crisis. That's really why you got to be extremely selective and careful in your investing. And looking at the current valuations, I think that small cap space just need an event, and that would in turn trigger a sharp correction in valuations. Now, do we even know when this will happen? Probably not, because we have been expecting this for quite some time and we've been wrong till now because nothing has happened. But it doesn't mean that nothing would happen. Something has to happen, but we don't know when. It is in such a scenario that we are maintaining our cautious stand on small caps, which is completely against what the market is doing. And we want to be correct in helping our mutual fund investors to invest where their risks are more moderate and controllable. The mutual fund investor is a small investor, unlike the PMS investor, and the mutual fund investor has big dreams. When you're a small investor with big dreams, you should invest conservatively when the valuations are not in favor, and you must invest aggressively when the valuations come back in your favor. At the moment, valuations are definitely not in your favor, and therefore the conservative stance is a necessity. But a time will come when you reverse and flip this conservative stance and adopt an aggressive stance. When it is the time to adopt an aggressive stance, it's probably going to be the time to get back into small caps progressively so that you could buy them at valuations from where you are having a higher degree of certainty of making money, and you also will end up making more money. That's a good proposition, isn't it? Thank you for watching this video.